Hello everyone and welcome to Stockbusters at TaipanFinancialNews.com. I'm your host Sandy Franks. If I were a betting person, I'd wager that you'd be shocked when I tell you the name of the company my guest says isn't worth your investment dollars. In fact, he says the stock is heading under $20 a share. That would mean a 35% drop from its current share price, certainly enough of a drop to cause serious damage to your portfolio. Let me introduce Steve Lord, editor of Trend Investor. Steve is here to tell you why Yahoo tops the list of stocks you shouldn't buy. Welcome, Steve.
Thank you.
Steve, you're not a fan of Yahoo right now. Why is that?
The major point is that growth is moderating at the company. It's done well, but it's not doing as well as it used to. Estimates have been pulled down sharply in recent weeks. The average 2008 earnings per share estimate was 80 cents per share 3 months ago. Now it's only about 71 cents per share.
But Steve, Yahoo is a search engine widely used by millions of people.
True.
Besides that, the company has been around for 12 years. It's got offices in Asia, Australia, Canada, Europe, Latin America, and the United States. Don't you think it's big enough and smart enough to weather any small dip in business?
Well, no, I don't really. I mean, the same could be said about General Motors, right? I mean, they're all over the world, but Toyota this week is now the largest producer. Didn't spend enough time looking at new products and new innovations. Google is eating Yahoo's lunch right now. The saying right now on the street is that if Google was Godzilla, then Yahoo would be Japan. Valuation is also very rich, considering the company's waning growth. It's got a 52 PE, compared with about 21 in the overall internet sector and 16 in the S&P 500. We're looking at about 15% earnings growth this year and about probably 11 to 12% growth in EBITDA. If you add that in with the valuation that the company is carrying, it equates to about a 2.5 price to earnings growth ratio. That's about, twice or a little bit more than twice the sector, which is about 1.4, and a 1.5 peg in the S&P 500. The stock is just simply too high for the kind of growth it's going to be delivering over the next 12 to 18 months.
Well, let's take a look at Yahoo itself. Top executives at Yahoo have a code name for a business plan called Panama, of course, after the vast canal project undertaken in the face of adversity.
That killed millions of people, by the way.
Okay, but I don't think Yahoo's going to kill millions of people.
Okay.
This business plan is a major overhaul of the company's search advertising system, and it's intended to close the growing gap with Google, which you said is the Godzilla, in the internet search engine. So it sounds to me as though Yahoo's management is well aware of the problems and even has a plan to turn things around. So are you saying you have no faith in Yahoo at all?
No, I think the company is still going to have a very good second option to Google, much like Airbus is to Boeing. They're not going to go away. Panama is going to do well. I think their paid search business is going to continue to wane a little bit in light of what's going on in the overall economy and the overall business of internet search. But Panama probably will have a little bit of traction. My point is that the company is simply too highly valued for the kind of growth it's going to bring in. Panama may work very well, but it's not going to be enough to justify a 52 PE.
Okay, since you're talking about numbers, let's talk a little bit more about the numbers that Yahoo's posting. I read recently in the New York Times that net revenue was up 9% from the previous quarter, this time last year. Are you certain that stock is headed downward?
Well, I mean, nobody's certain, but I certainly think that the 9% revenue growth is only something to be happy about if you look at the fact that it had a very easy earnings comparison quarter recently. And even then, it didn't really do as well as most people on Wall Street expected it to do. The stock lost about $2.50 per share after that announcement came out. So yeah, 9% looks good on paper, but you have to look at it in context to what people have become accustomed to Yahoo posting. Also, technically, the stock looks weak. I'm not a chartist by any means. I'm not a slave to charts, but I do use them and I try to look at what the market is telling me. And if you look at Yahoo's chart, it suggests lower prices between now and, say, the end of the year.
Okay, again, let's go back to what the company insiders are saying. In a conference call with analysts, Terry Semel, Yahoo CEO, said he was pleased with the company's performance. The results we put out were exactly what we expected. To us, it is a very strong performance, end of quote. So Mr. Semel is speaking about the first quarter results. Obviously, he's in tune with the numbers and the progress Yahoo is making. How do you counter this remark, Steve?
Well, I don't disagree with him in the fact that, in the sense rather that Yahoo did as well as everyone within Yahoo expected. The problem I have is what Wall Street expects Yahoo to do, and what the investment community is pricing the company to do going forward. Yahoo could very easily match or meet every single one of their goals that they have for the next 18 months. But if that's all they do, the stock will go down because Wall Street right now is looking for more.
Is it possible, Steve, that you're being impatient with Yahoo and perhaps that we'll see even more positive numbers in the next few months?
It's definitely possible. The company could come out and surprise significantly to the upside, but I will add that I think that surprise would have to be a very significant one, and it would have to be one that indicates the company is earning market share versus Google. That's really the only surprise I can see that's going to get the Wall Street guys to get their pencils back out, sharpen them, and remodel Yahoo. Right now, Google is eating Yahoo's market share every single quarter. Panama or North Panama, that's going to be their biggest problem. If they can come out and show that they're earning market share versus Yahoo, then we can revisit it. In the absence of that, I don't see even slightly better than expected numbers making a particularly large difference in the stock.
All right, well, we've got to quickly wrap up here, so let's just summarize this for viewers. For you, the bottom line on Yahoo is just get rid of it.
Well, yeah, I mean, the bottom line is that it's a good company. It's certainly been an internet pioneer. Like you mentioned, it's been around for 12 years, and it's a search engine that's used by millions of people. But I don't believe the stock right now, its business as it's presently conceived for the next 12 to 18 months, can justify a $28 per share stock price. I think it's heading under 20. The chart certainly argues for that. The business certainly argues for it. And I think Wall Street's expectations, even now, are still too high for this firm.
Well, you know, this is a stock I'm going to watch carefully, and I'm sure our viewers will do the same just to see if you're right,
Probably,
Steve.
right.
If it does fall to below $20, as you suggest, then you've given our viewers an advance warning of a stock they should remove from their portfolio.
Right.
But if it doesn't, well,
we'll be right back. Yeah. And very briefly, one of the things to realize is that it's not always, like I mentioned, it's not always about how well the stock does. It always is about how well the stock does in the context of what Wall Street expects. And that's really the play here.
Okay, that makes sense. Well, thank you for joining us.
My pleasure.
If you'd like more information on Steve's monthly newsletter, Trend Investor, you'll find it at taipanfinancialnews.com. To sum it up, your action today is to sell Yahoo. That's all for now. I'm Sandy Franks, and I'll see you again right here next week at taipanfinancialnews.com.